Depreciation. So what is depreciation? There are a lot of different ways this term is used, and it often depends on like what industry or what context you're talking about it in. Like if you're in the auto sales business or the insurance business, depreciation means like how much less your asset or whatever you bought is worth over time. So it's a measure of the decreasing value of an asset. Depreciation is often also thought of as a measure of the wear and tear on a piece of equipment or property, but it's basically, for most people, it just means like how much less is your thing that you bought worth now than when you bought it. But for tax purposes and accounting purposes, depreciation is a method for allocating costs or the cost of an item over its lifetime. So what does that mean? If I buy a piece of equipment for $100,000, I don't necessarily get a $100,000 deduction. If that equipment is going to be worth producing value for me as a business for more than a year, I should be allocating that $100,000 to the multiple years that it's effective or useful. So let's take a quick example. Let's say I am in the business of making 3D models, and I have a 3D printer, and maybe it cost me $10,000. Maybe I've had it for a while. My profit each year is pretty regular. I make $5,000 a year on this. And then, so year one, I make $5,000. Year two, I make $5,000. And then year three, I buy a second machine. So, and these things run, they don't need much, they don't need to be watched, they can run overnight. So I'm basically doubling my output when I get a second machine, just for simplicity's sake. So year three, and maybe it costs $10,000. So instead of $5,000 and $5,000, I made $10,000, but I also spent $10,000 on this machine. So a naive approach, you might think, well, I made $10,000, but I spent that $10,000, and I would have $0. And then year four, year five, I'd be up to $10,000 per year. And that would be kind of the idea of what you would do if depreciation were not a concept. But let's say these machines, they last on average 10 years. So what I should really be doing is, well, I should be depreciating that first machine that I had. So really, I would be in the middle of depreciating that first machine that I owned. So this is with depreciation. And then, now that $10,000 that I spent on that machine, instead of deducting it all in year three, I should really allocate that cost to all the years that I expect to be able to use it. Year three all the way up to year 12. So I make $10,000. I have $1,000 depreciation on my first machine and $1,000 of depreciation on the new machine. So I'm taking $2,000 depreciation each year. And the effect of that is Like if somebody looked at my books and records and wanted to, like maybe I was taking out a loan or something, and they saw this and they said, oh, what happened in year 3? That was a really bad year for you. I said, well, no, that was actually really good. I finally saved up enough to buy this new machine. I doubled my business. Well, that doesn't reflect in my profit and loss or my income statement. So this depreciation gives you a more accurate measure of what your business is actually producing income-wise from year to year, which is why accountants and the IRS like this, prefer to do it this way. So this I can say, so a bank or lender or possible investor could look at my books and say, oh, year 3, what happened there? And I said, oh, I finally saved up enough for a second machine. I doubled my output. That was a great year. And that reflects the actual facts of what happened in year 3. So that is what depreciation is in a nutshell. You're going to allocate or spread out the costs over the multiple years that a piece of equipment or building or any other asset is useful.
In an example like this, where say someone operated their business for a few years, and at the end they decide to not operate their business anymore, and they have this leftover depreciation, how can they go about using that depreciation that's left over? Can they take it all at once if they're closing the business, or do they still have to continue depreciating it over that same schedule at the end if they decide to no longer operate?
Yeah, that's a good question. I'll answer you just a second.
We're going to get into that later.
Yeah, that's a good question. So Dimitri asked, what do we do if we stop using some equipment for our business, but we haven't taken the full depreciation for it yet? And the answer is that becomes our basis. Because let's say I bought a machine for $10,000 and I depreciated it for 3 years, and then I closed my business. I spent $10,000 on it, and I still have $7,000 worth of value left to extract from that machine. And if I was still using it in business, I would extract $1,000 worth of value from that machine for the next 7 years until I extracted all the value. So I still have $7,000 left to extract from it, which means if I sell it for $7,000, I actually broke even. I got those $3,000 worth of deductions, and then I got my $7,000 back. So, or if I abandon it, if I throw it away, no one wants to buy a used 3D printer or something like that, turns out. So if I throw it away, then yes, I can deduct that last $7,000. But I would not continue depreciating over the remaining life, because it's not actually producing value for me anymore. So for depreciation, we need to answer a few more questions, like what can be depreciated? And the answer to what can we depreciate is any equipment, building, etc., with a useful life of more than 1 year. Because if its useful life is less than 1 year, then there's no need to allocate the cost. We can all put that in the 1 year. Even if that year straddles the end of a year, we just put it in the 1 year.
What do you see these days with like electronics, like things like phones and laptops? Are those depreciated or are they almost viewed as disposable and expensed?
It depends. Let's see. So there's, that's a separate question. So is it something expense or depreciate? And that's going to be, it's often based on the facts and circumstances. The base rule is if it expects to produce value for more than 1 year in your business or other income producing activity, then it should be depreciated. But there are some gray areas and there's some like de minimis or small enough that it really doesn't make it that much of a difference. Nobody cares what the difference is. And for the IRS, they've actually come out with a ruling that anything that is under $2,500 we can expense. So under 2,500 we can expense. So if I buy a new cell phone that I'm using for business and it costs $1,000 and I'm using it 80% for business, I can just deduct the $800. If I buy a new computer that I'm using in business and it costs $2,100, I can deduct that. If it costs $3,000, I would need to depreciate it. So that's going to be like the difference between where I put on the Schedule C. I'll usually have an item, usually as a subcategory of supplies, where I'll put small tools and equipment. Like things like, you might buy a power drill or a screwdriver or just a bunch of tools, and you don't know if they're going to last more than a year or not. Especially like screwdrivers and wrenches, you're going to lose them. Lose some of them you're going to hang on to. Those are all super cheap, and nobody cares that you depreciate them, as long as they're under $2,500.
So I have an example. I bought a skid steer attachment. I think my cost into it's like $2,000. And then I got then I had to ship it up, and that was like $800 or $1,000 or something like that. Actually, yeah, 1,000 or 100. So overall, I'm over 3,000 into it. But given that I have the base cost of the unit being under 2,000, or right at 2,000, and then the separate shipping costs, is that an instance where I could just depreciate the whole thing? Or expense the whole thing?
Yeah, you could expense it because those are two separate invoices. So it's under $2,500 per item or invoice.
Okay.
So if you got it already shipped and you have paid the $2,800 in one lump, and you had one invoice that said $2,800, you would have to depreciate it. But if you bought it for $2,000 and you separately paid $800 to somebody else for shipping, then you would have two separate invoices. But if your invoice said $2,000 plus shipping, $800, $2,800 total, that'd be one invoice.
So
this is
if the
$2,500.
vendor covers the shipping, you're paying the vendor to cover the shipping, then it might be a scenario where you end up having to depreciate it as a particular expense. Okay.
Another example would be like if you're building like your warehouse, like some of the windows are broken and you replace some windows, is that a repair or do you have new windows that you have to depreciate? And this $2,500 is going to be the threshold on whether it's going to be one or the other.
So, like I buy a chainsaw for my business, it's only about $900, brand new.
Right.
So that would be an expense, I wouldn't appreciate it, even though it's supposed to last more than a year.
Yes, you would expense that even though you expect it to last more than 1 year. You still have the option. This is a safe harbor, like the IRS will let you just deduct it, but it's an option. Like if it turns out better for your tax situation to depreciate it instead, you could take the standard depreciation.
And then another question that I have. So I've been buying stuff to start this tree business because I'm going to do more than just trees, but I've been buying stuff over the last few years. but I've been getting hurt, so I haven't been able to start the business, so I've just been buying. Now, can I use the stuff that I've already bought for the business, even though it's a couple of years ago that I bought it, when I start the business, can I use those as expenses?
Not yet,
Not yet.
not yet.
Okay. I have to have the business when I buy it.
Yeah. So that's another question is when can we take depreciation? And that starts when the item is in service and ends when out of service or fully depreciated. Okay, so you're planning to start your business, you haven't started it by the end of the year, but you bought all this equipment to prepare for that. That equipment is not in service yet, so you cannot depreciate it yet.
Right.
In service means that it is ready and available and actually being used for its intended final purpose in your business.
Well, I guess I asked it wrong. So the stuff that I already bought, when it does go into business next year, then will I be able to use it as an expense for that year when it goes into business?
Yes.
Okay. I was just making sure that I didn't shoot myself in the foot getting all this stuff
Right.
beforehand.
Yeah, you will get to deduct it, just not on 2023.
No time.
So would that be under certain categories, or would that just go into his like business startup expense category or something like that?
That would count as business startup expenses. If they're expenses, they'll be business startup expenses, and if they're large enough to depreciate, they'll begin depreciation when you actually start using them in your business.
So even though they may fit into some of those particular categories, if he had a bunch of things that they bought over the course of the year prior, then he would just bundle all that into the startup.
Yeah, there's a special rule for startup expenses, which is, we'll cover amortization also. So I'll just put this parenthetically, amortization
Yeah, I read that in the book. What is that?
is basically, is like depreciation, but for intangible assets or long-term costs. So the money you spend to start your business actually benefits the business as a whole for as long as the business exists. So technically your startup expenses, so if you spend money to get your business ready and you have certain expenses, maybe you signed a lease and you have to pay 1 or 2 months worth of rent before your business actually starts, or you buy equipment in preparation, equipment and supplies preparing for your business to start. Count all that up. Those are all startup expenses. They're not deductible until your actual first day of business, but instead they'll be amortized. And the rule for amortization is if your total startup expenses are less than $25,000, you can deduct $5,000 the first year and amortize the rest. So if your startup expenses are under $5,000, you just take the whole thing in the first year you're in business. If your startup expenses instead are $20,000, you deduct the first $5,000. The other $15,000 is under amortization, which is the same thing as depreciation. It's just a different term for things that aren't, physical, tangible things that you can pick up and move. Which is.
So what would be an example of things that people would amortize as opposed to just put it into the other categories?
Startup expenses, patents that you buy, other intellectual property, software that maybe you hired someone to develop for you. those are examples of intangible assets.
So most small businesses may not have much things that don't fit in the normal categories that we could just throw in there instead, right?
Right.
It's mostly probably larger businesses with IP and such.
Yeah. Or let's say you buy an ongoing business and you do an inventory of like all the assets they own. So let's say you buy someone's, maybe it was my 3D printing business, my custom models. And they say, oh, it looks like you're making $8,000 a year. That's pretty good. We'll buy your business off of you for $80,000. And then they look at like what I actually own. I have these two machines that maybe fair market value, they're worth $8,000 each because they're used. Well, what are they buying with the other $64,000? Well, they're buying intangible assets. I might already have a customer base. I might have built up a brand. I might have a website. People trust my brand and all that. So those are intangible assets, and those would also be amortized. That's an example of an intangible asset.
So is that almost exclusively in an accrual system, not a cash basis system? That would happen?
That would, whether you're doing your taxes or books on a cash method or accrual method, that'd be an intangible asset either way. And you would still need to amortize that. They would not be able to deduct the $64,000 that they paid me for building up my business.
Gotcha.
Yeah. Normally, when you buy a business, you buy a lot more than just the physical equipment that they own. So everything that can't be allocated to the physical equipment would be allocated to intangible assets.
So intangible assets is kind of that catch-all category for everything that they can't place a value on specifically.
Yeah, and that's specific things, customer lists, goodwill, going concern value, those things those are terms that accountants will use. Those are all lumped together for the IRS. They're called Section 197 intangibles. That's basically the value of the business above and beyond its physical property that it owns.
Section what?
Section 197 intangibles.
All that brand value, stuff like that.
Yeah, another example is maybe a local tax preparer wants to retire and go out of business. And so they might come to us and say, I've got 250 customers, I want to refer them all to you, I want you to pay me $50,000 for those referrals. And we might say yes or no, but what are we really buying? Well, we're buying that goodwill. It's an intangible asset. It's not something that we can pick up and move and carry across the room. That's an intangible asset. So that $50,000 that we would pay for that, that's also not really an expense because it's definitely more than $2,500. And it is likely to benefit us more than 1 year because we might win those customers and retain them for multiple years. So because it's more than 1 year, then that's when amortization would come into play. So we'd be basically buying a customer list for $50,000. It's probably more than we would actually pay, but that's an example. And then other types of intangibles might be, I've got this really good, she might say, oh, I also got this really good tax preparer that works with me, and and a secretary, you can take them too. So that would be like a workforce in place intangible, but those are all combined into Section 197.
So most of the time when you see a lot of intangibles, it's either a startup expense or it's an acquisition expense.
Yes.
Okay.
Mm-hmm. Yeah. Intangible assets are almost always going to be startup expenses and acquisition expenses. But other types of intangibles would be loan acquisition costs. Like if you're refinancing, if you already have some debt and you're refinancing that debt, then the fact that you have this new lower rate loan is not really an expense because it doesn't really directly help your business, whether you owe this person or that person. but it does kind of indirectly help your business, and it helps for more than 1 year. So loan acquisition costs or loan refinance costs, that kind of thing, would be more than 1 year. Or if I was starting up a business or expanding my business, let's say, I need to borrow $100,000 to expand to a new location. That helps with the lease. That helps with hiring new people for the new location, new equipment. So I need $100,000 to expand to a new location. The interest expense will be deductible as I go. But let's say it cost me $10,000 out of pocket to process this loan. That $10,000 is helping my business for multiple years, and it's more than $2,500. But it's not a tangible asset, therefore it's amortized.
Even though it's completely a sunk cost as soon as you've paid it, or as soon as you open the loan.
Right, but it's beneficial for more than 1 year. So just like the equipment that I bought that cost $10,000, that helps me for 10 years, this loan that I get will help me for the entire term of the loan until I pay it back. So that is an intangible asset that is going to produce value for my business for multiple years, the fact that I was able to borrow that money.
When, in these cases where it's added from a loan, is it usually just added into the loan, or is someone actually paying for things like?
Often it's added into the loan. Like if you get a small business loan, that would be like a 3 to 7%. I don't know what the percentage is right now, but there will be loan processing fees, and that'll just come off the top of your loan. So you might borrow. I might want $100,000, but I really have to borrow $110,000 to cover those fees, which are paid to the bank, and maybe a broker or somebody. So that $10,000 is actually not paid to me, but I get $100,000 cash. That extra $10,000 of indebtedness is, benefiting my business for the entire term of that loan. So it's going to be amortized.
Okay. I just figured if it is just added into the loan, you'd think that they would just show the loan amount of 110, right?
Right. I borrowed $110,000, and then out of that, I paid $10,000 to the bank that facilitated this loan for me.
But the interest that counts on that full 110 is still just bundled together with interest in general, right? No one's separating that.
Mm-hmm.
Okay.
So I don't get to deduct that $10,000 right now because it didn't instantly help me. That by spending $10,000, I didn't make an extra $20,000 that I would expect. If I spent $10,000, for example, on an employee, I expect them to produce a lot more value for the business as well as themselves. So I expect that $10,000 to help me for the entire term of the loan.
Okay, yeah, I just realized because it shows up on your balance sheet, but it doesn't show up on your income statement the moment that you got that loan out, right?
Right. So it would go on your balance sheet as
Liability.
your liability would be $110,000 that you owe to SBA, or to the bank actually. I think SBA guarantees that they don't actually loan the money. But $110,000 that I owe to SBA, and then I'd also have a separate asset of $10,000, which is loan acquisition costs that I would amortize over how many years that the loan goes out for. So, and that would be considered in service as soon as I got the money. Okay, so what can we depreciate? Any equipment, building, or etc. Amortization is for intangible assets. And it's similar, but it's going to use different rules than for regular depreciation. When can we depreciate? We can depreciate when that equipment, building, etc. is placed in service. We stop depreciation when it's taken out of service. And then how much can we depreciate? this is gonna be the total cost or other basis and the cost is considered everything, all the money that you spend to acquire that equipment, building, or other asset, and to bring it into the use that it was intended for. So that is also, so it's going to be whatever sticker price is plus whatever freight charges and installation charges are required. And if you bought it from overseas, there would also be any customs charges and any import taxes and things like that.
So, for my bucket truck that's still in Fairbanks, the batteries that I had to buy for it, those can be added on to the depreciation value.
Yep.
And then, since it's gonna have to sit there for the winter, the storage fees with that.
Yeah.
And then the shipping it down next summer will all be incurred in the depreciation.
Exactly.
But because you're not in business technically yet, you basically have to add that all into the basis. But if someone were in,
It won't be here until next year.
no,
so-
I guess I'm trying to make the point. If someone were in business, they would essentially have the choice of all those accessory fees to the main unit, all those, repair and transportation, everything. Could they just choose to expense all that?
No, it would be part of the basis.
Oh, okay.
It's gonna be, since I'm buying it, it's gonna be everything that I have put into it to acquire it and get it to where I need it and get it.
But in the example of my skid steer attachment, and if you have the transportation cost of bringing it up and you have the initial cost of purchase, you said if it's both of them are under 2,500, then you can essentially choose to expense them
Right.
separately, right?
That's where your choice comes in. That's why you have a choice, is because it's under 2,500. So if your skid steer cost 3,000 and separately the shipping was 800, then it would all go in here. Well, the 800, because it's not a 2,500 expense, we could probably get away with putting it in here. But if you bought like some heavy equipment, if you bought something for 100,000 and it costs you 3,000 to get it shipped up here, that would all go into the cost basis.
Really, so someone couldn't choose to take that full $10,000 shipping expense that it cost that much to bring something up. They couldn't choose to just expense that shipping.
Correct. Correct.
Okay.
And technically, that would be considered freight. The accountants use different terms in different ways. Shipping is the cost of you sending something, and freight is the cost of you receiving something.
So inbound or outbound. Okay.
So that freight expense would be part of your cost basis. So, and if you bought a truck and it was not operational and you hired someone to fix it, then that cost would also be part of its basis. So any necessary repairs to bring it up to
Working order.
yeah. Another example, and a fairly common one, would be somebody might buy a house with the idea of renting it. But it's been trashed, it's totally, unrentable, it's unlivable. So they buy a house, they're gonna remodel the kitchen, they're gonna fix the windows, they're gonna bring it up to code. So they buy it for $100,000 and they spend another $50,000 fixing it up. Now their cost basis is $150,000.
Cool.
And that all goes into the cost basis. So all of these expenses that are required, so any deferred repairs that you buy a property subject to, when you actually complete those repairs, that actually does adjust your basis.
Okay. Yeah. Oh, I forgot to ask this earlier. So I always thought it was under 1,000 you expense it, over 1,000 you have to kind of depreciate it. So this $2,500 value, did that change recently in the tax code where before a certain year you would do it differently?
I believe this is from 2017.
Oh, okay.
Before that, so in about 2015 and 2016, it was $250. And before that, and this is like a safe harbor, where the IRS will not question you whether you should have depreciated it or expensed it. before that, there was no dollar value. And it was just based on the facts and circumstances. Is this really a repair, or is it a new thing that you're placing into service?
Okay.
So the question, so another example would be, like, if your truck, you had to replace the engine, is it really a repair, or is it a new engine that's a separate depreciable asset? And that, it's a small dollar amount, but that kind of thing might take a lot of argument between the taxpayer and the IRS, and maybe even the courts will get involved. It's a small dollar amount, so the courts would probably settle it way before you got to court. But the point is, the IRS said, you know, if it's this small, we don't really care. We're not going to spend the man hours to say, oh, you should have depreciated this $2,000 computer instead of deducting it.
And if you have like your 3D printer machine, for example, and it only costs you, you know, $2,000, and you used it for a couple of years, later on, if you close the business and 5 years later you actually still dig it out of your attic and you sell it, are you still doing something as like a business and just selling stuff to capture the value that was maybe?
Well, if I bought it for $2,000 and I deducted $2,000, I've already extracted all the value out of it. And that leaves me with a basis of 0. So that's another way of thinking about basis. When we were talking about IRAs before, and when we were talking about stocks, we talked about basis as being the money you've put in that's already been taxed. But another way of thinking about that is that that's value that you put in that you have yet to extract. So when we're talking about basis going up and down, like in partnerships, and when we talk about adjusted basis as part of chapter 14, that's another way that we're thinking about it, is value that you've added that you haven't been able to take back out yet. So by buying this machine, I put $2,000 cash in there, but by taking a $2,000 deduction, I get the benefit, the value right away. So now I have no basis left. So if I sell this machine that cost me $2,000 for $500, I have a $500 gain because I already got all the value. So I got $500 extra value out of it. So now that's why I have a $500 worth of income.
Even if that happens years later after the business is closed, but one would technically need to show that gain.
Okay, so this is how much we can depreciate over the whole life of the asset. And another question similar is how much can we depreciate per year? And this is going to have to wait until we go into the slides, because it depends on the useful life, it's going to depend on something called the convention, and it's going to depend on certain choices we make the first year we put it into service, or elections.
Elections being like the accelerated depreciation of sections 179.
Yeah, bonus depreciation section 179 is what we mean by elections.
What's the convention? I've never heard of that before.
The convention, so the useful life, so let's go through each of these. The useful life is how many years is it going to be useful? And I guess there's a fourth one method, but I'll leave that off. And the IRS actually has the tax code actually has specific categories that every piece of equipment or building falls into that tells you what the useful life is. So both of these are going to fall under something called the modified accelerated cost recovery system, or MACRS for short. Before, this is a modified, there used to be ACRS, and these were standardized in like the 80s. Before the 80s, the useful life would be whatever, you know, your experience is. Whatever useful.
What was the acronym again?
Modified Accelerated Cost Recovery System. Before things were standardized in the 80s, businesses, companies would say whatever useful life they thought. You know, in our experience, this metal stamping machine, they typically last 12 years. And so they would just say 12 years. Our fleet vehicles, our delivery trucks, they typically last 3 years before we have to replace them. So trucks, 3 years. And maybe they want a bigger deduction, so maybe they cheat a little bit and they say, well, although we know, instead of taking 12 years, why don't we say 4 years on the stamping machines? And it was just chaos, because the IRS would say, oh, you took too much of a deduction, they'd have to go to court, and the courts would say, well, after polling, you know, a bunch of experts from other can making companies, you know, this is what they say. So to get rid of all that cost of litigation, they say, well, no, they're just going to fall into certain categories based on what that equipment is and what it's used for. So we have 3-year, 5-year, 7-year, 10-year, and 15-year categories, and I think there's a 20-year category. And then there's also residential, rental, real estate, and then there's all other real estate. And as a side note, your business use of home counts as other real estate because you're not using it, you're not renting it out. You're not using it as a residential rental. You're not renting it out to a family to live in, you're using it for your business. Let me just double check, I think there might be a 25. 3, 5, 7, 10, 15, 20, and 25.
And so, how does one determine which category things fall into?
Yeah, IRS does that for you.
You look in the chart in the book on page 10 and 11, and that will tell you. There's also a more detailed chart at the end of, I want to say it's publication 926. Let me double check that. Nope.
These days,
946.
I'm looking at like the 7-year desks, files, and safes and stuff. A lot of that stuff these days is probably a lot cheaper than it was in the past. If it's like a $500 desk, is someone really going to depreciate it, or are they just going to expense it?
No, because you're going to expense it because it's under 2,500.
But if you've got a $20,000 furniture build out of like a new office or something, then you might
Right.
depreciate it. Okay.
Yeah, and then you, if it's under 2,500 per invoice, you could still depreciate it if you really wanted to. But it's probably not going to be worth the effort.
Because if they depreciate the whole thing up front, they have a lot more options how they want to deal with the dispersal all that office furniture if they close down or they have to move offices or whatever, right?
Yeah.
They don't have to have as complex of a,
Yeah, so if I were starting, let's say I were starting a brand new tax office. Let's see, I would need computers. I'd probably need 1, 2, 3, 4, probably at least 5 computers. I'd probably, running at about $2,000 each. So I'd need $10,000 worth of computers. I'd need a couple printers. I'd need a credit card machine. I'd probably, and then I'd need furniture. I'd need, decor and decorations. I probably would need at least $25,000 to completely furnish, at least $25,000 to completely furnish a new tax office. So all that equipment and furnishings, I would probably want to depreciate that because I wouldn't want, because often when we have these depreciation, when we have choices regarding depreciation, it's usually not a good idea to go negative. Because remember, self-employment tax is based on your profit each year. So if I had the option, if I had a choice of having $15,000 in profit in 2 separate years, or I could have $10,000 loss in 1 year, which would mean $40,000 profit in the next year. In one case, I'd pay self-employment tax on $30,000, and in the other case, I'd pay self-employment tax on $40,000 because I don't get negative self-employment tax. And even though that loss technically does carry over from year to year, it only carries over for income tax purposes, not for self-employment tax purposes. So yes, maybe sometimes you want to reduce your deductions, and that's one way that these options that we'll look at in the future can help a lot. Another reason you would want to reduce your deductions, therefore increasing your income, is when you have income-based credits, earned income credit and additional child tax credit. In this case, I might get child tax credit and earned income credit both of these years, but if I did this, I would get nothing for this year, and I might get nothing again for this year because now my income's too high. So yeah, so we have choices. So if I spent that $25,000 on new equipment, I don't necessarily want to deduct the whole $25,000. Okay, so these are our useful life categories, and the 2 main ones are going to be 5-year, which is it's called data management equipment, which is a fancy term for computers. Computers and peripherals, anything that's basically in that category. And it's also going to include furniture that is used in a residential rental activity. And it also includes vehicles. So 5-year is computers, vehicles, and furniture that you're renting in a residential activity.
I see things like carpet are in here under 5 years. So if someone has a rental property and they redo the carpet, they're not able to count that as repair. They have to, because it's listed here, depreciate it over 5 years.
Yeah, unless it's under $2,500, then you'd have the option of treating it as a repair.
Okay.
What did I say? Computers, residential furniture and fixtures, and vehicles are the main ones. I guess they say office machinery, so that makes more sense. And the other category that is the next most common, or I guess they're both about equally common, is our 7-year property, which is most equipment, and it actually has the catch-all. Anything that doesn't fit in any of these other categories is 7 years.
So I don't really see heavy equipment, like construction equipment,
Yep, that's gonna be 7 year.
but then I do see initial clearing and grading land oh, that's land improvements, not equipment, okay. On looking at 15.
Mhm.
Okay. So usually I guess that would be in 7, okay.
Yeah. Some quick examples of things that are in these other categories. 3 year is tractors. The front half of a semi are depreciated over 3 years instead of 5. Even though you think as vehicles they would be depreciated over 5 years.
That's because they do all that work.
An example of 10 year is water transportation equipment, boats. So we have a lot of fishermen. We have a couple of people who own fishing vessels. The fishing vessels are 10 year equipment.
Question, on the tractor 3 years, so those guys buying what is now like a $200,000 semi-tractor, right?
Mm-hmm.
They might be financing that over like a 5 or 7 year term,
Mm-hmm.
but they're probably depreciating it over 3.
Yep. Yep. So if you buy a $200,000 Kenworth tractor, you're going to deduct $67,000 a year for 3 years.
Even though that first year you may only have 10 grand out of pocket or 20 grand out of pocket or something.
Yeah.
You're taking a larger deduction than you even paid into it.
Mm-hmm.
Okay.
Yeah, because when you borrow money and when you pay money back, that doesn't affect your tax return at all. The proceeds from your loan and the payments on the principal have nothing to do with your taxes. So whether you financed it or bought it outright, it's the same deduction.
So if you finance an $80,000 truck, you basically pay nothing down. You're still able to take that whole deduction.
Yep.
And offset your taxes for the year.
Mm-hmm. And that brings us to another reason why you might not want to do that, is because if I finance an $80,000 piece of equipment or a truck that I write off, I get an $80,000 deduction. Well, over the next 5 or 7 years, I still have to make $40,000 worth of payments, and those payments, or what, an annual payment might be $15,000. I still have to pay $15,000 a year toward that vehicle. I've already written it off, and I get no further deduction because I already deducted it. So that creates a problem that's sometimes called phantom income. Even though you might take nothing home, maybe your business was just barely breaking even, you barely made enough money to make the payments on that truck, you still have $15,000 of income that all went toward paying that truck. You have to pay taxes on that $15,000. So now suddenly you have phantom income. So sometimes you want to avoid that by spreading out your depreciation over a similar term or the same term as your loan is.
So if you say you have the semi for 3 years,
Mm-hmm.
after the 3rd year, when your depreciation is out of that, you trade it in for another truck.
Mm-hmm.
Would you depreciate the new truck for 3 years?
Mm-hmm.
So you could just keep rotating it, and that way you don't lose out
Right.
until eventually you can pay off the truck in 3 years.
Right. Let's see. 15 years is 2 types of things that I'm familiar with, and that is improvements made directly to the land. So that'd be grading, paving, certain landscaping, putting up fences. That's improvements made directly to the land. And the second one that falls into this category are called leasehold improvements, and that is where you're renting a space and you build walls or you install plumbing or do things like that because you don't get to take it with you when you stop renting. So instead of making you deduct it over as if it were other real estate, so any changes you make to real estate that you're renting goes into a 15-year instead of any other category.
Why do they stretch it out so long on tenant improvements type of, if, they may only be there for 5 years or something like that? I guess,
Because because it lasts as long as the building. So they give you kind of like a split the difference kind of thing.
and then what happens if, say, 5 years in on this 15-year term, you end up moving locations? You are able to take the rest of that at that time?
Yeah, that's considered an abandonment, which is the same as selling for $0. So if I buy a building, or no, if I'm renting a building that was formerly, let's say, a lawyer's, a law office, and I say, well, I want to make a restaurant out of this, I would have to put a lot of money into it to make it a restaurant. And maybe I spend $100,000 on it. And turns out, in the last 6 years before I have to shut down, so I still have like $60,000 of value that I haven't extracted yet. Well, I can't, there's no possibility of me extracting any more value out of that because I've walked away from my business. So, and the landlord gets to keep it. They'll probably just, the next tenant will probably take it out. Or they might rent it to a new, the landlord gets to keep the value that I put into it. So I've lost that value. So then I get to deduct it in that final year. 20 and 25, I don't really know, because those have to do with utilities and gas stations. I don't think I've ever had a 20-year or 25-year property.
Yeah, it looks like farms and sewers and stuff like that.
Oh, farm buildings would actually be in there. So anything other than a single purpose farm structure. So I guess 20-year we might see occasionally, but most of our farm businesses don't have like a barn or stables and that kind of thing. Okay.
So I have a question. On the 25, it mentions water utility kind of property.
Mm-hmm.
So we're gonna have to build a pump house for a community water system. And if we hold on to the rights for that community water system, would that initial cost of building that pump house be what would be depreciated over the 25 years? Even though it may not be attached to a separate piece of property, essentially? Or how does that work?
No, I don't think so. I think that would be 15-year property because it's an improvement to the land.
Yeah, you're not a utility company.
Well, we're gonna have our own water system, and that we probably would be charging for.
Yeah, so if you have like a community well that you're distributing to the tenants in the neighborhood that you're developing, I don't think that would be 25-year property. I don't think that would make you a utility. But that's something that you might have to double check on. So that is possible, but I'm pretty sure that's 15-year property. Improvements directly to the land, which includes like running cable and running fiber.
Okay. But in the case of like when we develop land and we have to bring in, gas and power and other utilities, usually the way we think about it is we just divide it by the number of lots and change the basis of the lot. Are you saying, or is this?
Are you renting those properties or are you selling them?
Generally developing and selling.
So that's not depreciable at all. Because depreciation, because that's part of what you're selling. So that's part of your inventory, your stock.
Okay, so it's kind of like that goes into the cost of goods essentially,
Right.
or it gets divided by the lot or the basis,
Yeah.
increase the basis of the lots.
Yeah. So the way you were doing it is correct. You would just
Okay.
divide it by the number of lots or the number of acres on each lot.
Okay, I just didn't know on the pump house for the water system, which we haven't got that far, but I didn't know if that's something that we'd have to separate out.
No, you wouldn't have to separate that out. If let's say some sort of conglomerate, like some corporation wanted to buy like the entire place and say, well, we're gonna turn this into resorts that we're renting to people instead of selling, then they would want to depreciate that over them. That might be water utility property to them. So if you were, you know, or if you had done it yourself, you had developed all these lots and your plan is to rent them, then that might be water utility property in that case.
But if we have a mixed use where we might have some rental property and then single family property all within the same subdivision, we would simply, at least initially, just divide it up based on lot and then
Yeah.
not try, okay. So ultimately, with some of these 20 and 25-year versions, unless it's very clear that you fall in that category specifically, you generally default to a different one.
Yeah. I mean, and I don't think that really falls into 25-year property anyway. Because we're talking about like sewer property and like your equipment that like cleans and reprocesses water or maybe desalinates water and that kind of thing.
So that's like if you bought an entire water processing
Yeah.
property over acreages that just deals with water treatment.
You buy that stink plant there in Palmer, by the golf course. They got a water treatment center out there. And then there's one in Big Lake, or not Big Lake, Eel River. Trust me, you don't want to get into that line of work. I had to go do power locates, do both of them. It took me like 3 days to get the smell out. It's close.
Alright, so that was all about useful life. Conventions are, so I did say, like for example, so you might depreciate something over 5 years. So, but you don't get a full year of depreciation the first year. You get a prorated amount. So if I started using my equipment in August, you might say, well, you know, there's 125 days out of 365. So I'd only get that part of a year worth of depreciation the first year. Then I have 4 full years of depreciation, then 1 final year that covers whatever part of a year I didn't depreciate the first year.
So how do you divide it then?
The convention lets you skip knowing exactly what day and having to do a separate computation for every single piece of equipment you bought during the year. So a convention says there are 3 different conventions. There's mid-year, or there's mid-month, mid-quarter, and half-year conventions.
So it's not a matter of you bought it December 31st, you can still take a full year that year?
A half year. So the mid-month convention is used for these 2 categories: rental, residential rental, and other real estate. So it doesn't matter what month you place your property into service, if it's a building, or real estate also includes any essential components of a building. So if I started renting out my house in March, doesn't matter whether it was March 1st or March 31st, I get half a month's worth of depreciation. So whatever my full year's depreciation would be, maybe $12,000. Divide that by 12, I get $1,000 per month, which means I get a half a month for March, $500, and then a full month for the other 9 months, or another $9,000. So I get $9,500 of depreciation that first year. That's the mid-month convention. That applies specifically to real estate.
So even if you put it into service like March 1st, and you're technically the whole month, you have to take a mid-month?
Right.
Huh.
While I'm gone, if my partner loads my dump truck full of wood, because when I get back, we plan on starting a business. So if he loads it full of wood, say January 1st, so it's full of wood and it's being used to keep the wood out of the weather until it's delivered when I get back, would it be in service then?
Yeah, I would say so. So that's your mid-month convention, which is only for real estate. I should have put these,
I say you can't technically put it into service though, right, before you start the business.
Right.
So even if it is sitting with stuff in it,
But see, the
right, but
IRS
that portion of depreciation might go into startup expenses.
the IRS doesn't care about a business license. So
Right.
they just care about the money that's being made. So if I'm using it to make money before I get the business license, it's still for the business. And it would be in service.
So yeah, you might have equipment that's in service before your business technically starts. The start date would be when you first find your first customer, or you sign your first contract, or open the doors for the first time to accept customers. For residential rentals, it would be when you first are ready to accept tenants and are actively advertising for tenants. Or even if it takes you a while to get your first customer, your business could be considered to be starting when you're first actively advertising your services. Let's see, then we'll skip ahead to the half-year convention. This is for everything else, all of these that have less than a 25-year or less. Actually, I think the cutoff is 20 years for some reason. Let me double check. Yeah, it is 20 years. So any 20-year or less property uses the half-year convention. So if you placed your vehicle in service on January 1st, you'd get a half year's worth of depreciation. So it'd be as if it'd be the same thing as if you placed it in service on June 30th and a half.
So you don't get a full year of depreciation.
Right. So everything is half year for all this other equipment. So 25 is actually going to be lumped in here with the mid-month convention. That is unless at least 40% of your equipment was placed in service in the last quarter. So if you buy a whole bunch of stuff, or you buy maybe your only equipment in December, hoping to get a whole half year's worth of depreciation on it, then instead you're going to switch down to the mid-quarter convention. And if you fall into this category where you have to use the mid-quarter convention, use the mid-quarter convention for all of the depreciable assets of 20 years or less that you bought for the year. So if I buy $5,000 worth of equipment in March and $5,000 worth of equipment in October, March is the first quarter, October is the last quarter. 5,000 out of 10,000 is more than 40%, which means I have to use the mid-quarter convention on all of my equipment, which means instead of a half year on all of my equipment, I'll get 7/8 of a year on some of it and 1/8 of a year on the rest of it. Or it might be different depending on when exactly I bought those.
40% of what again?
40% of the total depreciable basis of this equipment, 20 years or less that you bought.
So if you have 20 pieces of equipment that are all being depreciated that were maybe purchased over the last 10 years.
No, whatever you put into service that year.
Oh, of that year. Okay, so it doesn't look at what stuff was purchased the prior years.
Right.
As a part of that 40%.
Right.
Okay.
So all that older stuff is still going to stay on the half-year convention. But if you bought, if the only thing you bought was a work truck for $80,000 in December, you're not going to get your expected half year's of depreciation on it. You're going to get a month and a half depreciation on it.
No, why don't they do like a full year of depreciation? Because the truck's not running for half the time, or?
Right. Yeah, they're just rounding to the midpoint.
And what was the 40% again? If you bought more than 40% within the last half year?
Within the last quarter.
within the last quarter, okay.
So if you bought, if you bought all of your equipment on September 30th, then you get the full half-year convention on everything. But if you bought more than 40% of it October 1st or later, you're using the mid-quarter convention on everything.
Okay, so this is a rule to, I guess, make it a little bit more challenging, or get less of a benefit for everybody who's buying a bunch of stuff in December.
Right.
Okay.
Yeah.
But if your stuff's spread out through most of the year, then that probably won't really apply to you as much.
Right. Yeah, if you're buying equipment all year long, this is not going to apply to you. But if you backload your equipment purchases to the end of the year, maybe to get your income low for tax purposes, then they're going to say, well, you don't get as much benefit for that. So it kind of reduces that incentive for, you might consider it abuse or not, but it reduces that incentive to just buy a bunch of stuff at the end of the year.
But then they could potentially overcome some of that with elections, right?
Yeah. So finally, so the third category of what's going to affect on how much you can depreciate per year is going to be bonus depreciation. And section 179. Now, a lot of this discussion was kind of, not entirely, but a little bit irrelevant over the last couple of years because bonus depreciation from 2018 through 2022 was 100%. You could just say, oh, I'm just going to deduct it under bonus depreciation. But starting in 2023, bonus depreciation is 80%. We'll talk about what that means a little bit later. But 80%, that means if I bought a truck for $40,000, I could deduct in 2023. I can take bonus depreciation of 80% of that. I can deduct 32,000, and the remaining 8,000 would fall under this.
Depreciation over the next 5 years.
Mm-hmm. But you can combine these also, it turns out. So I can take 80% bonus depreciation and $8,000 with the section 179 deduction to get the full 40,000 out of it.
In 1 year.
Mm-hmm. This bonus depreciation, though, is it's an election, so you can choose to or not to. But bonus depreciation is is a full yes or no on each category of equipment. So if I bought, let's say I bought 3 trucks, for business purposes, they were each $40,000. So I can either take 80%, so $96,000 bonus depreciation, or I can take none. I don't get to choose anywhere in between. Yes or no? Am I going to take, since they're all 5-year property? So do I want to take bonus depreciation on all my 5-year property or none of my 5-year property?
So it is flat 80, it's not up to 80?
It's flat 80%. 2024, it's going to be 60%. It's going to go down by 20% each year until it's gone.
Oh, so they're really trying to do away with it right now.
Mm-hmm. Yeah, it'll come back. It always does. But that's going to take until the next Congress, probably. Before 2018, it was 50%, and it had been 50% for as long as I'd been doing taxes. But right now, it's scheduled to phase out 80, 60, 40, 20, and then 0. They'll probably bring that back. But
So
there's
that's-
no guarantees.
So that's going to be really important for those people that are generally maxing out their section 179, right?
Mm-hmm. Yeah, and one of the reasons they wanted to do that is because they wanted to really heat up the economy. Like Trump wanted to make his numbers look good, so they wanted to make sure businesses were reinvesting as much as they could into the economy. Some of these things, both sides do this. They set tax traps for the next president. So they set up this bonus depreciation, and they set up the Tax Cut and Jobs Act to reduce everybody's taxes. The Tax Cut and Jobs Act expires in 2026, so people are, unless something is done in Congress, taxes are going to bounce back up in 2026, and whoever happens to be president in 2026 is going to take the blame, even though they have nothing to do with it. This bonus depreciation, because people knew it was going to go away, they were investing a lot more into the economy, really heating up the economy, and the fact that this is going away might all by itself help induce a recession, because people aren't going to want to invest as much without as much depreciation deduction, unless Congress changes that. But this is going to go away, let's see, 80 in 2023, 60 in 24, 40 in 25, 20 in 26. So this is going to be gone in 2027. So you'll get like this slower depreciation.
So,
And businesses that don't get to take advantage of bonus depreciation, their taxes will go up, and they'll blame whoever's president in 2027, even though they have nothing to do with it.
so when you take the bonus depreciation of 80%, and you basically take that full amount your first year,
Mhm.
how does the rest of the 20% go?
The rest of the 20%, so you can kind of think of this, it's been a while since I've had to remember this ordering rule.
I mean, does that get divided on the per year basis of other stuff, or?
I believe so.
I mean, assuming you had a 5-year life cycle, or useful life, and so you take all those 4 years in that first year, does that just mean you have 1 year left the next year that you take the rest?
No, that means the other 20% goes through the full depreciation process. So, and I got this section 179 backwards. Section 179 actually comes first before bonus depreciation. So if I bought this vehicle for $40,000, I get $32,000 the first year, plus the other $8,000 goes through the regular depreciation process, which means I'll get another $1,600 depreciation the first year. And then, so total depreciation of about 33,000. And then next year, I'll still get depreciation of like $2,000. And then I'll continue depreciating that on a basis of $8,000 until over 5 years, until it's fully depreciated. So whatever doesn't go into bonus depreciation goes into the regular depreciation method.
Okay, so you kind of do both regular and bonus at the same time, effectively,
Right.
assuming you're not doing 179.
Yeah, it's bonus depreciation, and you won't find bonus depreciation in the tax code. It's called additional first year depreciation. So it means you get to, first year you place something into service, you get to deduct 80% of it, and whatever's left is deducted over the normal lifetime of the property. And then section 179, which is technically first, is your choice of a dollar amount between $0 and the full value of the property, except for vehicles have an upper limit. If they're heavy vehicles, I believe it's 25,000, and passenger vehicles, I don't remember. It's been a while since I've had to deal with section 179.
When you say heavy vehicles, what does that mean? Like a truck?
Anything with a gross vehicle weight rating over 5,000 and under 14,000 pounds.
That's what it says.
So
Or I
you're,
think you're right, between 6 and 14,000 pounds.
so those vehicles, you're limited to 25,
Yeah,
and then the rest of it goes into a normal schedule?
yeah. So it actually goes in this order. So whatever your cost is, you get to put it into section 179 first. And then whatever's left after section 179 goes into bonus depreciation, and then whatever's left after bonus depreciation flows into your normal depreciation. So I think I'm gonna erase this over here so I have a little space so I can give an example. So for example, if I buy a truck for $40,000, I can take $25,000 for section 179. That's going to leave $15,000 left over. 80% of that is 12,000. And this is bonus depreciation. And that's going to leave $3,000 to go to normal MECRS macros depreciation.
So does heavy equipment have a limitation like that as well?
No,
Okay,
No.
so that was,
that's just vehicles that are normally used over the road. So that $25,000 limit only applies to heavy vehicles. And if I remember correctly, smaller vehicles like light work trucks or passenger vehicles, they have an annual limit on the total amount of depreciation you're allowed to claim in the first year, counting all of these three categories. So you could technically take a full section 179 deduction, but you only get to take that cap each year.
so it's between 6K and 14K GVWR.
Mm-hmm.
So I've got my F550 with the, or whatever heavy truck that's in that range, that I wanted to do the 25. But if my truck's kind of even heavier duty and I'm past the 14K, then I don't have that limitation that I can take the full amount if I want.
I'm pretty sure now, yeah.
Okay. Because I mean, we got trucks that are like, rated for like 25 and a half or 26.
Mm-hmm.
That you don't need the CDL, but at the same time, they're not your lightweight trucks.
Right, that's how my bucket truck and my dump truck are.
So those, you're not limited by a 25K. You can depreciate the entire amount if you want.
I'm pretty sure, but
Okay.
I don't know the rules actually for vehicles over 14,000 pounds because I haven't worked with any of them
Okay.
before.
But if that truck's not very expensive anyway, say it's a $40,000 truck, like in this example, then really you may not have much left at the end anyway,
Yeah.
even if you did have the limitation. Okay. And then that Macker's, you basically divide that 3,000 over 5 years at that point.
Mhm.
Okay.
Yeah, and it's and Macker's is going to turn out is not perfectly divided. It's not, you don't get to divide it just by 5 and take that amount each year. I mean, you can if you want, but you get a little bit more toward the beginning of its life cycle than you would toward the end. That's because equipment is, when it's new, it's more productive, more efficient. It goes down less for repairs. You need to put less money into it for repairs, so you get more value out of it early on in its lifetime. So this example of the first example I gave of where I bought this equipment that's useful for 10 years. First of all, the IRS rules, the Macros rules will tell me 7 years instead of 10. Secondly, I would deduct extra the first few years before I would deduct more the first few years than I would in the last few years. Because it's predicted to be more efficient and require less time for repairs and less downtime.
And whether you bought that used or new, you use the same schedule?
Mm-hmm.